It's some business news this morning. Shares in Microsoft has slumped hard overnight with its loss of value close to an all-time record, about 400 billion US.
As Windows Central reports here, this was the second largest single-day stock decline in history, wiping an absurd $440 billion in market value from the tech giant.
Bill Gates is losing it after Microsoft just lost $400 billion in a single day. Not over a month, not over a bad year. One day. Shares dropped more than 10%, at one point nearly 12%, and just like that, $400 billion in market value disappeared. Analysts in Australia called it a car crash. That number alone would cover entire national stock markets. And this was not some small tech startup. This was Microsoft, the company that once defined stability.
Ross, good morning to you.
Good morning.
So the US markets have just closed. How did Microsoft finish up?
Not real good. I've got to tell you, this is a car crash. Have a look at this. $400 billion wiped off the value of Microsoft shares overnight.
Wow.
Here's the part that makes it even crazier. Microsoft actually reported strong earnings. They pulled in $81.3 billion in revenue. They beat Wall Street expectations with $4.14 per share. 10 years ago, those numbers would have launched the stock into the sky. Instead, investors hit the panic button. So what happened? Why did Wall Street treat good numbers like a disaster?
The shares still trading down more than 10%. At one stage, they were down 12%. That's where that $400 billion US basically comes from. And that really would cover about the top 6 or 7 companies in Australia, just the loss overnight in Microsoft shares.
Because Wall Street stopped caring about the past quarter. They started looking at the future. And the future, according to Microsoft, is artificial intelligence. Bill Gates and the executives have been talking about AI like it is the second coming of the internet. They bet everything on it. They poured money into it like there was no tomorrow. And suddenly, investors started asking one simple question. Is this making real money?
Now, normally if something like that happens, you'd imagine the rest of the tech sector would go as well. It didn't though, and we can show you this because it's effectively a whole bunch of other shares reporting quarterly earnings which go to the end of last year. But the real concern now is the amount of money they're spending on the rollout of artificial intelligence. And as a result, also in the giant data centers they're building.
Let us talk about Azure, Microsoft's cloud engine and supposed AI rocket ship. Azure grew 39%. That sounds incredible. Any normal company would celebrate that. But hedge funds were whispering a different number. They wanted 40% or more, 1% short, and suddenly confidence cracks. Next quarter guidance drops to 37 to 38%. Growth is slowing, momentum cooling. In the AI arms race, slowing down is dangerous.
We're talking about a single-day drop in share price of 5.37%. And while that number may seem small, keep in mind that Microsoft is a multi-trillion-dollar company, so 5.37% of that is pretty significant. It's in the hundreds of billion.
So I have to ask, Bill, since when did 39% growth become a disappointment? Since when did investors expect infinite acceleration? Did you really believe Wall Street would fund endless AI spending without demanding proof? Because that is exactly what happened. Investors looked at slowing growth and exploding costs and decided the math no longer worked.
Be honest here, and really, given the fact they started with zero, everything over a couple of billion is, sort of gravy, but they are down quite a few $billion each of them in the past 12 months. So, as I say, it's just interesting to see this. But tech shares, and again, that's about AI, and really the market's worrying whether Atlassian has got a future.
Now we get to the real heart of the panic. Spending. Microsoft spent $37.5 billion in just one quarter on AI infrastructure. That is up 66% from the previous year. If they keep this pace, we are talking about $150 billion annually. That is the size of entire national economies. That is nation-level spending for computer chips and data centers. 70% of that money goes into GPUs, AI chips, and giant data centers. NVIDIA chips stacked in warehouses the size of stadiums. Electricity bills that look like small countries. And here's the catch. A huge portion of those GPUs are not even being used by customers. They are being used internally. Training AI models, powering Copilot, building tools that many users barely touch.
But right now we got to pivot back to Microsoft because those shares, as I pointed out, are falling sharply by more than 11%.
Wall Street did not need a PhD to understand the problem. You are spending $150 billion a year. Growth is slowing. Profit margins are under pressure because memory and component prices are rising. Where is the return? Where is the payoff? If this is a gold mine, why does it look like a furnace burning cash? Amy Hood, Microsoft's CFO, warned about rising hardware costs. That is not what investors wanted to hear. They wanted to hear that AI is printing money. Instead, they heard that costs are going up faster than revenue. That is not innovation. That is risk.
I'm going to show you why Wall Street is finally doing the math on this AI bubble and how things are not adding up.
And let us talk about OpenAI. Microsoft proudly announced $625 billion in future cloud commitments. That sounds massive, but analysts started digging. 45% of that backlog comes from one customer. One, OpenAI. So almost half of your AI future depends on a single partner. That is not diversification. That is concentration risk. Microsoft owns about 27% of OpenAI. But OpenAI is not exclusive anymore. They can use Oracle. They can use other cloud providers. They are also burning through billions of dollars a year. So Microsoft's biggest AI bet depends on a company that is losing money and can shop around for other partners. Does that sound like control?
And the end result right now is that as of January 29th, 2026, Microsoft lost a whopping $440 billion in market cap as shares tank. You can actually see this for yourself.
Bill, did you really think Wall Street would not notice that almost half of your cloud growth story depends on one startup that is still figuring out how to turn profit? Because once investors saw that number, the fear spread fast. If OpenAI slows down, if funding tightens, if regulators step in, that backlog shrinks overnight. And here is what makes the whole situation look even worse. Microsoft is spending like AI dominance is guaranteed, but the returns are still theoretical. Copilot adoption is modest. Infrastructure is underused. Growth is decelerating. Meanwhile, Google controls its own chips and models. Meta is showing immediate revenue lift from AI ads. Microsoft is promising future magic while burning present cash.
And it's this concern over their capital spend which really has caught up with Microsoft in particular. But there's another stock out there which did much better, and that is Meta, which is the owner of Instagram and Facebook. And I think we've got a few shares that we can show you here.
When the stock dropped more than 10%, wiping out $400 billion, it was not just about one earnings report. It was about trust. It was about investors suddenly realizing that the AI dream might not be instant profit. It might be years of heavy spending before results appear. And in markets, patience is limited. I look at this and I see a company that once moved carefully now sprinting into the most expensive technology race in history. I see leadership that assumed scale alone would protect them. But scale does not protect you from math. If capital expenditure grows faster than revenue, pressure builds. If guidance slows, confidence fades.
The way Windows Central frames it is that year to date, Microsoft stock is down overall 2%, wiping out all the AI-related gains it made over the past year.
Bill Gates built Microsoft into a fortress. Now the fortress is spending like a casino. You have to wonder what he is thinking behind closed doors. Did he expect this backlash? Did he believe the AI narrative would carry the stock forever? Or did he know that at some point someone would ask for receipts? Wall Street has changed the rules. No more blind faith in AI stories. No more applause for trillion-dollar spending plans without profit. Deliver proof. Deliver cash flow. Deliver real returns. or watch the valuation burn?
Well, the easy assumption would be that, Xbox having an off year, or, Microsoft's entire computing segment being down by 3%, according to Windows Central, are some key aspects of all of this, but it actually has more to do with Microsoft's commitment to artificial intelligence.
Now we move to the part that makes this even more uncomfortable for Microsoft. Copilot. The product that was supposed to justify everything. The product that was supposed to prove the AI gamble was genius. The flagship AI assistant integrated into Office, Windows, GitHub, everywhere. This was the crown jewel. This was the proof of concept. And yet the numbers tell a very different story.
And despite the fact that Microsoft saw growth in key aspects of their business, like how Azure, their cloud computing service, grew by 39%, which sounds fantastic, but Wall Street apparently wanted more. Investors were also unimpressed by the future-facing statement of a further 37% growth. Cloud revenue surpassed $50 billion, atop a huge $81.3 billion annual revenue, up 17% year over year.
Microsoft proudly announced that Copilot has around 15 million users. That sounds big at first. 15 million is not small. But then you remember something very important. Microsoft Office has hundreds of millions of active users worldwide. Some estimates put it well above 300 million. That means Copilot adoption is somewhere between 3 and 5%. After billions spent, after endless marketing, after force-feeding it into every product.
Microsoft 365 Copilot was up 160% year over year. GitHub Copilot was up 75% year over year. Shareholder returns were up 32% year over year too.
Let that sink in. 3 to 5% adoption for the product that is supposed to justify a $150 billion annual infrastructure spend. That is not dominance. That is lukewarm curiosity. And analysts noticed immediately. They asked the obvious question. If AI is so revolutionary, why are so few people actually using it in their daily work? Investors compared Microsoft to Meta. Meta raised AI spending by around 70%, similar to Microsoft. But Meta also raised revenue guidance. They showed direct improvement in ad conversions. They showed measurable lift. AI made the money now, not later. That is the difference. Meta's AI spend translated into profit visibility. Microsoft's AI spend translated into bigger data centers and future promises. Wall Street is not emotional. It is mathematical.
0.1%. If we have a look at some of the stocks there as well, you'll see that Meta was much, much stronger, up by almost, at the end, 10%. You can see Salesforce so got hammered down 6%, IBM up by 4.6%. So depending on the sort of way in which they basically produced those results, really ultimately had the determination on the stock price at the end of trading.
When Meta spends more and shows higher revenue guidance, the stock goes up 10%. When Microsoft spends more and shows slowing Azure growth and weak Copilot conversion, the stock drops 10%. That is not bias. That is capital allocation discipline. Even Microsoft's own executives admitted Copilot has not moved the needle the way they hoped. Analysts described it as hard to use, struggling, and not materially impacting business metrics. That is brutal language. When you invest tens of billions into AI chips and model training, and your flagship AI tool barely shifts revenue, investors start asking uncomfortable questions.
If Microsoft is taking their revenue and their profits and pouring it back into AI, a segment that is still very uncertain in terms of its financial profitability. Microsoft is investing tens of billions of dollars in not only building out AI infrastructure with the purchase of hardware like NVIDIA GPUs, but also they are investing in other companies like OpenAI.
So I have to ask again, Bill, was this the grand strategy? Spend like there is no ceiling. Build infrastructure at nation scale, and then hope customers slowly figure out how to use the product? Because that looks like the current situation. Infrastructure spending at record levels, adoption crawling, investors watching the gap widen. Think about how that looks from the outside. Gates warned publicly that when growth comes from spending instead of revenue, you are in dangerous territory. Then his foundation dramatically reduces exposure. Then the crash hits. You can imagine investors connecting the dots in real time. If the founder is lightening up on shares, what does that signal?
Some of these stocks, when they do fall as aggressively as they do, you got to sit there and look at the very long term.
Some analysts say the sell-off was just portfolio rebalancing. Maybe it was, but timing matters in markets. And the timing here landed like a hammer. The company loses nearly $400 billion in a day. Investors remember Gates's warning. They remember the stock reduction. Confidence cracks a little more. At the same time, the broader tech sector began repricing risk. Atlassian dropped sharply. Cloud software companies fell 40 to 50% over recent months.
And so Atlassian shares down more than 10% last night. And if we go out a little bit further, what you can see is over the course of the past year, Atlassian shares are down by 56%. Now, given the fact that I worked out that each of them have got effectively have taken about a haircut last night of about 500 or 600 million Aussie dollars.
The entire AI trade began to look stretched. When one giant like Microsoft stumbles, the ripple spreads fast. Suddenly, capital expenditure across the sector looks excessive. Suddenly, free cash flow projections look optimistic. Investors started rotating into safety. Gold surged past $5,000 an ounce. Silver jumped more than 100% over the year. Bitcoin spiked. The Australian dollar hit multi-year highs. These are not random moves. These are signals. When capital runs from tech into metals and alternative assets, it reflects fear of overvaluation.
Some of these stocks, when they do fall as aggressively as they do, you got to sit there and look at the very long term. And the one thing I'll tell you about this is the Australian dollar. So we've got a chart of the Aussie dollar here to show you, and that is basically being able to show you exactly where the dollar has gone. Because a lot of people, with the big fall in the Aussie, or big rise in the Aussie dollar, which has now gone to nearly 4-year highs against the US currency.
This was not a broad market collapse. The S&P 500 remained relatively stable. That is what makes this even sharper. The market did not panic about everything. It panicked about AI-heavy capital burn without clear return. It panicked about companies spending like governments without showing profit like businesses. Wall Street is now saying something very simple. No more AI fantasy. No more trillion-dollar dreams without quarterly proof. Show me margin expansion. Show me operating leverage. Show me that your $37.5 billion quarterly AI bill produces measurable revenue lift. If you cannot show that, expect volatility.
It touched 70.9 US cents. We haven't got it there at the moment, unfortunately. It's now at zero. That's not a good sign, is it? But I can tell you, it basically is sitting around 70.5 US cents right now. It reached 70.9.
And that is where Microsoft stands today. Not bankrupt, not collapsing, but under scrutiny like never before. For years, AI was a free ride for valuations. Announce a partnership, raise capex, talk about model improvements, watch the stock rise. That era appears to be ending. 2026 is shaping up to be the year when investors demand cash, not charisma. I look at this and I see a company caught between legacy strength and future risk. Windows profits under pressure. Server margins squeezed. AI infrastructure exploding in cost. Copilot adoption is modest. Azure growth slows slightly, but enough to trigger alarm. OpenAI dependency large enough to matter.
Microsoft is investing tens of billions of dollars in not only building out AI infrastructure with the purchase of hardware like NVIDIA GPUs, but also they are investing in other companies like OpenAI, which Microsoft has been a huge supporter of and has already invested like dozens of billions of dollars into. But as I've reported through multiple videos in the past,
Bill Gates once built Microsoft on disciplined software execution, products that worked, systems that generated steady revenue. Now the company is navigating the most expensive technological gamble in its history. AI may transform everything. It may justify every dollar spent, or It may require years of painful adjustment before real returns appear. When the market wiped out $400 billion in a single session, it was not declaring Microsoft dead. It was delivering a warning. Capital is not infinite. Patience is not guaranteed. If AI spending continues to rise faster than AI revenue, the valuation will compress. If Copilot does not convert beyond a few percentage points, pressure will intensify.